Hey everyone, today we're going to talk about sale of businesses in Singapore. Before I start, I would like to say, for goodness sake, if you are buying over a business or if you are investing in a business, please do your due diligence. You should always do your legal and financial due diligence. I've come across many people who buy over businesses or invest in companies without doing their due diligence. I mean, if you're going to spend $500,000, $1 or $2 million to buy over a business, why can't you just spend 20 or 30,000 on your financial and legal due diligence? You don't want to buy over a company or invest in a company and find that there's a whole lot of problems. So that's all I have to say as a preliminary. Now next, sale of businesses can come in two forms. One is a share sale and one is an asset sale. I will first discuss the share sale. During a share sale, the seller is the existing shareholder and the buyer can be an individual or a company. For share sale, the buyer will usually buy 100% of the issued and paid up share capital. So the buyer buys 100% of the shares of the shareholder, the selling shareholder. So in other words, the buyer steps into the shoes of the seller because of the transfer of the underlying shares. This is the company, these are the shares. So nothing changes at the company level. All the assets and liabilities remain with the company. The buyer assumes the liability under all contracts, all debts. There is no change in the employment status of employees because this is the company. The company employs the employees, whereas you are buying the shares here, so nothing changes to the employees. Now, because you are buying the shares in the company, you're assuming liabilities and debts as well as the assets. Okay, there will need to be this thing called completion accounts, which is usually done after completion, to minus or plus, to take into account movements of monies that have taken place before completion, basically to set off. You will also need more thorough due diligence because you want to ascertain the exact liabilities, okay, that the company has when you're buying shares. And therefore, you will also need a lot of warranties in the sale and purchase agreement. You should also get an indemnity from the seller of the shares so that if anything goes wrong, any of the warranties are breached. You buy over the company, you discover that it is in debt, or there are guarantees, or it hasn't paid salaries, or rather you can claim under the indemnity. Another benefit of a share sale, because nothing changes, the customers, suppliers are all dealing with the same company, so they're more comfortable because of the years of there's continuity of the business. Another thing you should note for share sale is that stamp duty is usually payable by the buyer. Next, I'm going to talk about asset sale. Asset sale is a sale of assets only, and usually goodwill, by the company and the buyer. The shareholder of the seller keeps ownership of the seller, the shares of the selling company. So this is a company. The shareholder of the selling company is selling the assets only, and maybe sometimes the goodwill, but it retains ownership of all the shares. Some people do this because they're afraid of assuming the debts and liability. So for asset sales, it's usually called cash-free, debt-free transactions because you're not getting any cash or any debt. One of the troublesome things about asset sale, which is essentially buying over a business together with your goodwill, is that all the contracts have to be novated. What is novation? Novation is a three-party transfer of a contract because a contract is between two parties, for example, the company and a customer. So when doing an asset sale, you will need to enter into a the former two parties together with the new buyer, a three-party novation agreement to transfer all the rights and liabilities under the contract to the buyer. So that's a bit of a challenge. You need the consent of all the suppliers, customers, landlord to enter into novation agreements to transfer all the rights and liabilities. Also, sometimes you have to get the release and transfer of security of assets from the banks, because sometimes assets are pledged to the banks as security or collateral. So you have to do the change of the owner of the assets. And then, although Section 18A of the Employment Act provides that for transfer of business undertaking, there is no termination and there is continuity. Section 18A also provides that you have to organize a town hall to give notice to the employees. But in practice, there are a lot of buyers in asset sale transactions who, as a condition precedent to the transaction, they will ask the employees to enter into new employment agreements with the buyer on same or different terms. For asset sales, you also need an apportionment clause. Apportionment means to divide, let's say, accounts receivable on this date belongs to who, debts before this date belongs to who, after this date belongs to who. Now, next thing I'm going to talk about is GST. GST is usually, or should I say most of the time, not applicable or chargeable for sale of asset transactions, because it is neither a supply of goods or services if the business is transferred as a going concern. So, if a business is transferred as a going concern, the seller of the assets will be left as an empty shell with the selling shareholder over here. So most of the time, the selling shareholder of the selling company will either apply to ACRA to strike out the company, or apply for winding up. So thanks for watching this video on share sale and asset sale for sale of business transactions.